Welcome to my YouTube channel, where we discuss all things finance. Today's topic is capital budgeting. Capital budgeting is the process of evaluating and selecting long-term investment projects that are expected to generate positive cash flows in the future. This process is critical to the success of any business, as it helps managers make informed decisions about where to allocate resources. In this video, we will discuss the importance of capital budgeting, different methods of capital budgeting, and some real-world examples of capital budgeting. Let's start with the importance of capital budgeting. A company has limited resources, and it is important to allocate these resources to the projects that will generate the highest returns. Capital budgeting helps companies determine which projects will provide the best return on investment. This is done by estimating the future cash flows from the project and comparing them to the initial investment required. If the cash flows are greater than the initial investment, then the project is considered profitable. There are several methods of capital budgeting, but we will focus on two of the most common ones: net present value, NPV, and internal rate of return, IRR. NPV calculates the present value of future cash flows minus the initial investment. If the NPV is positive, the project is considered profitable. IRR, on the other hand, calculates the rate of return that makes the present value of future cash flows equal to the initial investment. If the IRR is greater than the required rate of return, the project is considered profitable. Let's look at a real-world example of capital budgeting. Suppose a company is considering investing $100,000 in a new product line. The company estimates that the new product line will generate cash flows of $30,000 per year for 5 years. The required rate of return is 10%. Using the NPV method, we calculate the present value of future cash flows to be $120,015, which is greater than the initial investment of $100,000. Therefore, the project is considered profitable. Using the IRR method, we calculate the internal rate of return to be 12.1%, which is also greater than the required rate of return of 10%. Again, the project is considered profitable. In conclusion, capital budgeting is crucial for businesses to allocate resources efficiently. By using methods such as NPV and IRR, companies can evaluate investment projects' profitability and make informed decisions.